All right. Hey, everyone. I'm here today with Conor Lynch, and we're going to be talking about the future of FinPub. A lot of you guys know Conor. Conor, thanks for being here.
Yeah, absolutely. Happy to be here. I'm excited for it, really.
So everybody who's been kind of, I don't know, under a rock and might not know Conor. Conor has been involved in a lot of things over the last few years, right? So he had one of the most explosive growth stories in the industry with Wealth Press that culminated in a really enjoyable FTC case that has been recently concluded, and we'll get into that as we go. But besides that, besides being like just a phenomenal publisher, actually in copywriter, like Conor and I have been talking about some aspects of FinPub and these intersections with all the other areas of capital markets and finance for several years now. We've been he and I did a little exploratory biz dev media business that did a couple million in a couple months a few years back, just as part of all the stuff that I've been doing to trying to understand our role in capital markets. And so he's very intimately involved in the conversations and thinking processes that I've had as all this stuff is developed. And so we wanted to talk about not just that today, but also the direction of FinPub. I had just put out a video, I guess a couple of weeks ago now, on kind of what I saw is like these tailwinds that we've had in the industry for the last 10 years and how those are shifting and changing. And just to reiterate those real quick, because I want to get Conor's take on this and kind of have this conversation, because we're going into some other headwinds. They were, one, we obviously had the longest bull market in history. Two, we had a very fastly growing customer base, like the rise in non-IRA retail brokerage accounts has been in a massive bull market since for about almost 15 years, maybe like 12 years. And then we had this media environment where we had lots of new platforms coming online that the arbitrage to attention was really beneficial, and that's kind of changed. So with that, Conor, like, if we were just going to say, what's the state of the market right now from a FinPub perspective, like, how would you describe it?
So I would say it's sort of at an inflection point. And what I mean by that is you have these tailwinds that have been building for a number of years. And the investor interest in being self-directed, in having their own trading and investment ideas, other than a brief period during the early part of COVID, when everyone quit sports betting and became an option trader overnight, I think we're basically at the highest it's ever been. And especially in terms of the people who stick with this more longer-term investors, longer-term traders who aren't the kind of fly-by-night crowd, I would say attention is at the peak. So theoretically, we're probably at a point in time in history that is most potentially fruitful for our industry. But on the flip side, so much of what worked over the previous 12 years, over the last bull run through till into last year, has stopped working in the same way, has either slowed down or pieces of it have broken. And I mean, I know, because I talk to a lot of other operators in the space, copywriters, publishers, marketers, there's huge anxiety. And I mean, you hear it too. You know that people are asking big questions about whether certain elements of our business, and in some cases questioning whether the whole business is viable anymore. Mm-hmm. And I can understand those questions, but I think you have to look at them in the context of this kind of generational opportunity as financial publishing, the way that we've done it, is starting to go mainstream. And that's it. It's a much bigger opportunity than, people have talked for many years about building the next Agora. But I think that the real opportunity here is bigger than building an Agora, whether Agora does it or someone outside of Agora does it. And that's, also something we've talked about for a long time.
Yeah, and I think we can get into that. I think I want to back up some of your points, because I think before this call, you had a couple of really good points in terms of like the three kind of pain points that everybody is feeling right now as a publisher, and that really kind of illustrate the difficult environment that we're in. So you want to run through those real quick?
Yeah, absolutely. And you've touched on these in some of the previous calls and interviews that you've done, on the media buying side, for example. the cost of media in our space has increased dramatically. And even with some advertisers pulling back over the last bit, even with crypto hitting the skids, a lot of fintech dialing back a little bit on acquisitions, the spends are still so much higher than they were in sectors that are, I guess, neighbors of ours, but not exactly financial publishing in the traditional sense. That reaching the investor audience is more expensive from a pure paid traffic model than it's ever been. So that's a challenge. Acquisitions is way harder, and so the economics downstream from that becomes harder too.
And let's dive down on that, because I wanted you to share your experience in growing Wealth Press. YouTube was one of your that was your primary traffic source really for scaling, right?
That was the big one. That was the breakthrough.
So let's talk through like the difference in, and that was started in what year did you start doing that?
So YouTube we started doing in February of 2020. So we had the unique or fairly unique opportunity of getting in early on a platform at the same time as we were about to go into the period of hottest interest on the part of the audience in the history of our space. So,
right. And so you get into YouTube, it's working pretty quick for you, right?
Very quick.
It's very quick.
Very quick. We were seeing, in the early days of it, the CPMs were really low. I can't remember the exact number, but it was about 35% of where they ended up, which obviously huge difference. And we were spending $1 and getting $2 back pretty much within 24 hours. Mm-hmm. If you can do that, scaling is really, really easy.
Yeah. And so, but then over the course of how many years did it take for it to get expensive?
Sort of by mid 2021, the CPMs had definitely solidified in a higher range. We were starting to see it sort of January of 21, that CPMs were starting to creep up. That was because I have a lot of relationships in the public company investor relations space or investor marketing space. That was a period of time where spends on IR by public companies were really increasing dramatically. So I know that there was a lot of competitor spend that our industry wasn't seeing necessarily. Like you would talk to other pubs and be like, hey, like, are you guys ramping up spend? It's like, no, we're actually kind of hitting the wall here. Well, it's because these other guys were starting to spend a lot more, and they're looking for the same eyeballs, but their math is different.
Yeah, I want to pull this slide up real quick just to show people. This was in my other presentation that I think illustrates this point. And I was talking about the difference in user growth versus revenue growth on YouTube and other platforms, and how user growth precedes revenue growth. And so there's a point in the life cycle of any of these ad platforms where their user growth has crossed the chasm, which is a technical term in like the tech world, in terms of it's gotten to the early majority. So it's got huge scale. And then they start to really focus on monetizing. They start to focus on getting more people are coming in. So there's more competition coming in, but then the algorithm itself is getting better at building revenue for like YouTube in this case. And so if you look here, can you see the arrow that I'm around? Okay. So you're talking in 2020 to 2021 is when it starts to get harder. Yeah. And we noticed this with like COVID. This is across the board, that their revenue shoots up just like everybody's did in 2020 because more people are advertising. And then at the tail end of this, you see this big peak here, it stays high, which means they just got better at monetizing their audience, and that grew much faster than the audience growth over the same period of time. So here, these two charts, I take it from this first 2015. YouTube grew, 100% of its audience over that same period versus almost 600% revenue growth. And so the cost goes up. And so we feel that impact, and some sectors feel it more than others. But like, I wanted to tie your direct experience of actually scaling a pub to this, because it lines up time-wise with what we're showing here. And YouTube is the slowest growth on revenue compared to some of these other ones. like, where was it? I had like Facebook when it exploded. I mean, they monetized like before YouTube, Facebook was the place to be. That
Yep.
was the acquisition source when we go back to like the crypto boom, and like Agora Financial had like Google Display, Facebook, other places, and like they had this massive increase, almost 8,000% increase in revenue growth. And that's not coming from just like cheaper ads. It's coming from more advertising, more expensive advertising. And
Yeah.
so like these
The
patterns
platforms get
are
better over time at directing an ad to the likeliest, engager, whether that's for a click or some of the CPA. And so, your audience, your addressable audience technically shrinks a little bit, but within the broader pool, it's actually still getting bigger, but they get better at that targeting. And so CPMs go up. And so this, I mean, the bidders who can afford a higher CPM, they prosper a lot more.
right. Right. And so it's whoever can spend the most get the biggest benefit. And that's the customer that they want. And so that's a that was a tailwind that switches to a headwind at some point on every platform. Like
Yeah.
it's just part of the media platform cycle. And I feel like one of the problems we had, and this is I blame Telegram. No. One of the problems we had is that we had this cycle of like new ad platforms that were scaling. It was a huge benefit, right? You had Google Display, Facebook, YouTube, TikTok coming. And then you have this, all of a sudden, this dearth of new platforms where you can get both scaled attention and at a cheap price. And I think the crypto boom was part of, I use Telegram as a perfect example because Telegram they have 700 million users, which is right in that range of crossing the chasm to early majority.
Yep.
And in January, they only made $1.5 million, 2023. And to put that in perspective, in TikTok's history, when TikTok was at 700 million users, it was making $650 million a quarter.
Yeah.
Right. Because they had an ad platform and Telegram decided they were going to go full crypto. And they raised 1.7 billion. The SEC is like, hey, that's an unregistered securities offering, give it back. And so they grew their audience base and never developed a really robust ad platform that had, and so it's one of the huge missed opportunities that I feel like actually has downstream impact on all of us marketers, because usually that's what we've been able to do is a platform gets too expensive, a new platform comes up, we're able to go monetize it. And so it's almost like there's a lag. And then you compare it to Reddit, who was the darling of the meme stock craze, right? Reddit is only at like 300. Where is that? It's not that as big as you'd expect it to be.
Yeah. The interface is still pretty niche.
Yeah.
Reddit comments and everything, which, it's.
And their revenue growth explodes at a much lower user base than any other platform. And it's like they're monetizing earlier in their user history because they're owned by like Condé Nast now, I think.
Yep.
And so like they're not scaling up the way that like a YouTube did or Facebook did. They're like, hey, we've got a pretty good audience here. We're just monetizing it. And so it doesn't create the ad environment that is useful for all digital marketers of all niches to dive into. And so I do feel like there's a little bit of a lack of a platform right now, in terms of like a cheap Wild West period that like, holy crap, everything works. If you're just participating, it works.
For an acquisition model that's driven purely on paid traffic, there isn't a new fertile field for us to plow. With that said, it is probably easier now to get mass exposure to an idea, to a video, to whatever, than it ever has been in history because of the number of platforms that already exist out there. Just easier, maybe from an organic sense than a paid sense. If you know how to do that, if you have the distribution channels built to do that. So
I think that's an amazing point. And I think to frame that, like, I asked a question before about like, so one of the pushbacks that I've gotten on the idea that, hey, these tailwinds have really helped us and the environment's changed. And we haven't even gotten to all the pain points that you have yet. So we have to go back, circle back to that. But the most
Well,
consistent.
there's more pain.
There's a lot more pain. Um, uh, and just a, like, we're going to talk about the bad stuff to get into the good stuff. Like,
Yeah.
but the thing that I always hear is like, hey, the need for advice and guidance in financial markets and investing is never going to go away. So our product is never going to go away.
Yeah.
And I 100% agree with that. It's one of the best info industries for publishing of any niche, because it's a super big, super complex topic with lots of variation, lots of things. It's always changing, and like, you need information.
There's a
organized.
catalyst every minute. I mean, just look at this
Right.
weekend with Silicon Valley Bank going down. It's like, were they going to bail out depositors or not? Was I going to have to run to my regional bank in the morning and get my cash out or not? Like,
right. And so I 100% agree with that statement, that like the need in the opportunity for a paid information kind of service never goes away. My question is, and my thing that I think is less clear is, it doesn't necessarily mean that the existing product and acquisition model is going to continue to capture market share.
Yeah.
As it is, and things might have to change. And even people like Brett Holmes, who pushes back on this a little bit, is like, no, it's never going to change. And it's like, well, you're already the one talking about product as promo and going to live versus a newsletter instead of a newsletter. So you are changing. And so what
I think he likes to protest that more than he actually believes it.
well, that's, and I love Brett. Brett, I love you. And I'll say this, like, half of the fun of being friends with Brett is offended and makes these huge, strong statements that he only half believes. And he's not wrong about a lot of it, but it's that, but that idea that, like, will the existing model as it stands, both on the acquisition side and the other side, product side, continue to dominate in a FinPub kind of model? Yeah. And I think that's a question. And I think that, I mean, what are your thoughts on that? I have some thoughts on that, but
I think it gets increasingly more challenging. And I think, so when we were at your event in Jacksonville, you brought up that there's this, how much do they manage? 240 billion TAMP? Like, it's massive.
Yeah. It's like the top 2 or 3 TAMPs in the world.
Yeah. So, and they just started digital marketing, like 4 days ago. So
2020.
Yeah. Right. So you have these huge, the acquisition math is not going to get easier. It's going to get more difficult, because the competition from how those guys are able to spend money is completely different from how we're able to spend money. The value of an acquisition for them is like monumentally different than the value of an acquisition.
Right. They were thrilled to get their CPAs down from 30 something thousand to 20 something thousand.
Yeah. Yeah. I mean, for us, there's, a handful of pubs in our entire space that even have a product worth that much. Stansberry's Alliance, and then some of the more higher ticket coaching programs, and that's it.
Yeah. And Porter said that their LTVs were pushing 4,000, but they weren't over 4,000. I think they were like 30, they're 37 or 30. I forget exactly the number, but it was pushing somewhere in that range. And that's taking out, that's converted customers. That's LTV measured on people who bought a second product.
Yeah.
And so, yeah, we're not in the same price range when it comes to media.
To me, that means that there's going to have to be changes. And I think there's a couple categories of changes, new acquisition models, new editorial models, new ways of distributing your editorial beyond just sending it out to the already opted in email list. I mean, for a very long time, social has been this like bolt-on afterthought that no one really believed in, other than there's a few pubs that have done it. But by and large, it's been perceived as an afterthought. And because content hasn't been optimized for it, nobody's really focused on those channels. It was always given to like the lowest guy on the marketing poll, like, here's your time in this social media Siberia. And if you get through that, we can maybe put you in a place that matters. Maybe social matters.
Well, I think that's the biggest, change. Like it's almost like in I would put it historically as like it's kind of like the new e-letter, right? That the e-letter itself was such a huge innovation back, because now you can keep talking to your customer essentially for free at the time. And now like social is that new free content channel. But it still has the issue of like a view on social isn't worth a view of an e-letter, because the intent is different and like the friction to get there
Yeah.
is different. But that doesn't mean that a social first content model isn't kind of the way of the future, in the sense that like we know that we're the last market other than actual capital markets to move on to into marketing models. Like it's one of the benefits that we
they
have.
think we're on the crazy bleeding edge, which is wild.
I know it's
it's like we actually know very little.
But we have historically had a late adopter prospect market, and
Yes.
because of that, we don't have to innovate. Like we didn't innovate the hot list launch. Like I always use that as a perfect example of our space, and I'll repeat it again. Like the first hot list took over like 2014, 2015.
Yep.
We were doing them in trader education in 2008 and 9, and
yeah, I mean,
the internet marketers were
Jeff Walker invented that, right? For BizOp.
Well, it was 2001. Jeff Walker worked with John Rees on internet marketing secrets, and it was the first $1 million day that we in internet marketing, and it was a huge thing. And then Jeff Walker productized their process as the product launch formula. So that's 2001. So it's 14, 15 years to get to where it took over in our space. Same with the VSL, same with all these things that like, and it's good because we don't have to innovate. We just have to look and see what the internet marketing world has moved to.
Yeah.
Then I would say that the switchover market, I would argue, is actually the real estate investing education market. Like that's the closest thing from BizOp. It goes because it's a type of BizOp, and so are we in a sense, right? It's a type of BizOp that targets investing, and so they tend to be like, when things start working there, then that's the next thing that's going to come to our space. And so I tend to look at the real estate, like the Grant Cardones of the world and people like that, to see, well, what's working there, because that's most likely what's going to come here next, and where we should be looking to innovate, and not even innovate. We should be looking to copy and duplicate, because it's the other biggest mainstream market for education that's focused on investing.
And not an exact demographic overlap, but because they're all like, it skews younger for sure. And there's sort of two categories of the real estate investing market. You have people who actually have money and they want to deploy their capital, which is much closer to our audience. But then you also have like the BizOp people who are like bird dogging, listings and stuff like that, which is a pure BizOp play.
Yeah. And I would say there's similarities though with like the kind of the opportunistic trading market. Like trading was sold as a business opportunity for sure for a while here. And that's part of the boom that we just had. And I think that the parallels are really interesting. And so it's almost like, as an industry, that's where we should be looking at what's working there, because that's where we should be looking to try and duplicate.
I mean, you brought up Grant Cardone, and I think he's a great example. Regardless of your thoughts on Grant and his approach to real estate investment and his fund structure, his ability to drive eyeballs, probably drive significant amounts of fund investment from his social media audience, is huge.
He's over $1 billion now, I think, in the fund. And so, I think that social first cross-platform, like not one platform, but all platform marketing. And so to your point earlier about like, what's the next, like everyone's trying to build a new Agora. It almost seems to me like there's multiple pathways, like multiple theses on what that could look like. And I think one of them is being kind of that central business hub for a social first, like influencers around investing. Like that's one potential model. And so, going back to your other pain points though, because that was we were ranting on the first one. So that was media. But the other part of media is always copy, right? Because it's conversion. It's a combination of the math and the message. to get the attention to convert. And so I think you had a whole point. You had a pretty good point on just the nature of messaging.
Yeah, so that's obviously changing, and I mean, I'm fortunately or unfortunately probably better equipped to talk about this than most, because I've dealt with the Federal Trade Commission on this subject. Everyone knows this in our space. Like, what you can say in copy has changed significantly over the last 3 years. The Federal Trade Commission has always had what they call a net general impression standard. But the way that it was sort of enforced in our space and many spaces for years and years and years is they kind of ignored that. And it was basically like, say stuff that is true. Don't say stuff that's literally false, and you're kind of fine. Now they've shifted to enforcing, I would say, a fairly aggressive general impression standard. Well, what does that mean? That means that the veracity of your marketing claims, whether it's a permitted marketing claim or not, is not determined by whether anything is true or not true, but by the overall impression of the piece. So you can have a piece that everything in it is true, where even at portions of the piece, you're saying you're not making any forward-looking promises. But if they've determined that someone would, by implication, from what you've said, from the context of the piece, from the fact that there was a shot of a private plane in it or whatever it might be, if people would read from that they're going to make money, then you have a problem. And so that makes the copy environment quite a bit more challenging than what it was before. Even things as simple as using trade examples, which is the foundation of almost all of copy and financial, going back to the beginning. To single stock promos where, they talk about the next, they have, pitch the next gold mine, and they'd be talking about the previous 20-bagger gold mines and stuff like that. This is something that our space has leaned on for 30, 40 years, going back to the old snail mail newsletters. Mm-hmm. So what does it mean if you can't use those, or if you can't use those in the same way? It changes things. Where does copy go from here? Well, I mean, I think that there's more. You're going to have to lean on the mechanism of the trading strategy. I think you have to talk about results more in terms of the general average. So, like, one thing that we learned is if you're using trade examples that are close to the average winner from a service, then they're a lot more comfortable with that than if you are choosing the 5 best winners and including those. Mm-hmm. But those are sort of, in my mind, kind of like Band-Aids. And really, you need to shift to a different mode of communication, a different mode of speaking to the audience. Up until now, gains as a benefit has been the primary benefit that we lean on, but that's not the only benefit of what we provide. And when you think about the best buyers, the really long-term buyers, they know that these services are not risk-free. They know that these services don't produce only triple-digit winners. All of these things that some copywriters are worried about losing those tools. Well, the guys we're selling to already kind of know that they're not going to be getting exactly that. So you don't necessarily have to communicate to them in those terms. Mm-hmm. I think leaning on things like authenticity and real talk and saying, explicitly calling that out and saying, look, that not every trade's going to be a winner. That they're not all going to be home runs. Like, yes, we try to swing for the fences with this service. Yes, we do have some big winners. I've shown you some of those. But, and kind of proceeding from that kind of angle where you're the straight talker. Mm-hmm. I think selling more from, I don't want to say a cult of personality, but almost more from a cult of personality than mm-hmm. from the promises of the offer itself. Like, you look at Andrew Tate is a controversial figure, to say the very, very least. But if you look at how he built his audience, he does use some of the lifestyle marketing stuff that the FTC doesn't like, but he's not out there promising people gains, and yet he's still attracted a big audience of people who want to learn how to make money on the internet.
Right. But I think that, so, I mean, the problem with the way that some of the influence, this is actually one of the problems that we have with the FTC, our industry, and social media, is that lifestyle marketing is not good. And
Can't do it anymore.
social, that's one of the problems, is social is very lifestyle heavy. And so like Andrew Tate is a great example of that. Like, but at the same time, like, I think it's the part of him that, and I hate to use this because I just saw that Bobby Hicks, hey Bobby, uh, got banned on TikTok because he did something talking about Tate's audience, and he got permanently banned.
Whoa.
So like, be careful about like using controversial figures in your marketing.
Right.
Like the thing with it is like having, like, back up, trading in particular is having the hardest time with the copy changes.
Yeah.
Because trading in particular has been sold primarily based on gains, primarily based on income, primarily based on like examples, and less based on like what I would say would be like, for me, I always think of it as classic newsletter, which is you have an editor with a very strong perspective on not just the market, but the world. And they're interpreting the world through that worldview, and all of the investment stuff that they do kind of fits within the rubric of their worldview. And so what people are coming to them for is essentially like, make sense of this crazy world for me, and it makes sense, and so I invest along with you. And I think that that comes with a harder style of copy. It's an older style of copy. I think that Porter is, love him or hate him,
He's the best at that right now.
He's
in our space.
He's built the best, most stable publishing business, right? And I think about the copy that his team has put out over the years, and I think it was Patrick Beauvais who wrote a great thing called, it was the last bull market. And if I remember, and I get this wrong, but if I remember, it was basically like this, like, I mean, the gist of it is like, you're old. This is the last bull market you're going to experience. I mean, it may not have been that, but my point is that the idea is they're interpreting the world and what's going on in the world within the context of the investor, the actual investor, and they're telling market stories. And so they're telling the story of what's happening in the market versus telling the story about how you can get rich.
Yeah.
Right. Because you don't need to tell somebody who's an actual investor that you could make money off this so
they know why they're there.
Right. And so for me, there's this split. There was this war going on in terms of philosophical worldview on copy and publishing in general that is best epitomized by Joe and the team over at Agora Financial when it was booming, and kind of Porter's view. And one is, Porter is like talking to the investor, and he wants the most he wants actual investors, and he's positioned his business as kind of a traditional firm in the sense of it's a market research firm for retail that's actually independent. Whereas Joe and the team like had so much success taking what we knew from the digital marketing world of infotainment and selling the idea of like, this is infotainment. It's investor entertainment as much as it is anything. And there's a lot of truth in that, but then the copy the copy is very different in those two worldviews. Right.
Yeah.
And I think that's where like you have publishers who don't speak to investors. They speak to people who are just interested. And we have a segment of the customer universe that aren't really investing that much. They're just interested in this stuff. And then you have a segment who are kind of like serious traders who spend a ton of money. And you have a segment that is interested in trading as biz op. So they spend some money, they're good, but they're not loyal. And then we have like, all the gradations of investor, and how you build not just the copy on a promo, but I think the copy on a franchise. Like, what's your franchise worldview changes,
and the editorial ties into that.
Right. And so some of those are easier versus harder. And during, I think the time when the crypto boom happened. We had the cannabis boom. We had this long bull market, and clicks were cheap.
Yeah.
Like that, like attention grabby. Like, you know, I think of that Altucher promo with his Bitcoin gold eyes on the banner as kind of like the epitome of that infotainment period. And they spent, I mean, some ridiculous number in like 45, 60 days, something like 50, $60 million in media spend or some crazy thing, or 45 million, somewhere around there, right into that boom. And, you know, that copy approach is specifically the approach that the FTC has targeted.
Yeah.
So you have like this direct response thing of like, well, hey, we're just going to use what works because we're looking at the math and this works, versus now the FTC saying, well, I don't care if it works, like it's not going to fly. And so anybody who's, because it lasted so long, anyone who's built their career inside that copy model is struggling more now than ever, versus people who looked at, I think, who came up under the, wait, these are market ideas, these are investing ideas that maybe you missed some of the big gains during some of those booms, but not enough to make it so like you're out of business. Like, but you get the customer you ask for, and one customer is more stable than the other, and one customer is more marketable right now than the other, just I think because of the copy changes.
Yeah. I would kind of put it like this, and you know, WealthPress is not entirely built, but largely built on the back of the trader audience. And we had a big, I mean, we had some very serious traders who did trade large amounts of money, but of course we also had the subset that, you know, when stocks declined by 20% and all their call options got blown out, just because, you know, like there's a period of time where that happens, and they're trading with no risk management. So they're trading with 30% of their portfolio in an individual position, which of course we don't recommend, but some people do that. You know, those people are out of the market. They're not buying anything for years if they, you know, if they ever come back, versus an investor audience where, you know, if stocks are down 20%, you know, they might have a one fewer golf trip that year, but they're not dead. They still have the other 80% of their portfolio to worry about. So they still need your newsletter.
Right. Yeah, no, I think that's so there's a different mindset than about who you're targeting and how you target them. And I think that's a very important distinction to make right now, because it is like, it's like, I saw this the other day on one of the Facebook groups, was like, oh, the FinPub industry is dead because the FTC came in and regulated it. And you're like, it's not exactly the most accurate way to describe both what's happening and the state of the market, because the opportunities continue to grow. But like, it's the operating models that, and kind of the base assumptions about what's works and not works, I guess.
It's also not true that this means that trading as a product category is going to die or anything like that. Even if some of the core audiences for those products go away or become, you know, not really marketable, because the appeals that work for them are the more biz-oppy appeals. Investors love trading products. They just need to be positioned a little differently for them. My dad has been a subscriber to Stansberry and the Oxford Club for well over a decade. He's a Stansberry Alliance member. He's an investor. He's involved in venture capital. He buys trading products all the time. It's different. So while I think Porter's audience selection and the way that he communicates in editorial, I admire that quite a bit. I think that going forward, I'd want to be marketing more to an investor audience. I still think you can sell great trading products to that investor audience, and then it can be very lucrative to do that.
Yeah, I want to pull this slide back up again too, just to show, like, to drive that point home. This is the brokerage account churn in 2022, right? So you can see here that it was Gen Z and millennials who had closing accounts. Gen X and boomers were still adding accounts. And so like this to me is like the age and life cycle thing, right? Like, you come into the market for investing in your 40s and 50s because retirement is the life cycle thing that defines like your investing, unless you're rich and then you have like, you need to do it. And so like, that's the other life cycle thing, is I just got a ton of money and I got to do something with it.
Yeah.
But for the Gen Z and the millennials, like the millennials are just moving into their 40s. They're not, they're about to get into their serious investing years, but they're not as a group there yet. Gen Z was just fun traders. Like
Yeah.
it was a fun, it's an internet. It's like my 12-year-old asked me about how do I become an affiliate marketer, and ask about trading. Like it's a
Yeah.
much more like they're these younger digital nomads, like these types of like making money on side hustles and online is
Well,
just
and so
part of
that's
what their
interesting.
culture is.
If I could jump in really quick there, just for a quick second, it's like these kids, how are they finding out about these ideas? Because I guarantee you it's not from the old school like email newsletters and those sorts of things. Trading is an idea, affiliate marketing is an idea. These ideas are getting circulated, and the people doing that are getting them out there are doing them, are getting those impressions a lot cheaper than we are, because they're playing a different game. So that's kind of a, you know, back to a previous point, but I just thought it was super relevant, so I wanted to jump in.
It's super important, because I mean, it's like you look at like I mean Twitch, like you guys are getting 50-60,000 views like live for all kinds of stuff. In trading, there's a trading sequence of it. I mean, a lot of it's video games obviously, but like this is how information is consumed. And I think that one of the things that like is important as direct response marketers to always remember is that VSL as a format worked because it mimicked content, just like every other format innovation ever has in direct response, right? Like infomercials, look,
Magalog,
right? Bookalog, Magalog, like all of it, like it works so much better originally because it's like, oh, this doesn't feel like an ad. And the e-letter is like that. It's a content thing that doesn't feel like an ad because it's giving value. That's why it was so sustainable. And it is so sustainable. It's not like they're going away, but free content on social, going live on different things, whether it's TikTok or Google, I mean, YouTube, streaming, shorts, whatever you're going to do, like this is the new content formats that are becoming more and more consistent. And I know because I'm a perfect example of a late adopter. Like I hate new shit. Because I got enough stuff to deal with, right? But I know that by the time I'm like, the only people, like there are older people than me who are very late adopters, but like I'm not early majority. It's something I have to intentionally go after to say, hey, no, I got to look at this because it's important, because I know it's too soon because I don't want to do it. But I know now that like I'm going through reels, I'm going through like, you know, video much more than I ever have before. But the other thing that I notice is with the algorithms love the short content. There's a lot of things that I watch on the short content level, but it's the people that I engage with long form content, whether it's long YouTube videos or long podcasts, those are the people that I give my money to. And so I think that the content model, like going into all, like you're gonna have to have you have to be a full media company. I think it's really the thing.
Exactly. I think that's totally correct. I think, and again, you know, it goes back to before we would throw stuff on social as an afterthought. But if you look at, and I've had more and more conversations with guys who are very good at social, who've built, I have a friend who built a 3 million subscriber TikTok account, for example, and each of these platforms has a meta to it, you know, type formats of content that work. And the meta shifts every 6 weeks or less. And so, you know, you need to, as a business, you need to either as a business owner, be good at it yourself, or you need someone very smart who can stay on top of it. This isn't a role for a junior marketer who's just learning the ropes of the industry. This is something that is going to entail production costs in terms of the media itself, which is video heavy now. Some of that's getting easier with some of the AI tools, but it's still not, you know, it's still not free or zero cost or zero effort. And then you have to understand the meta of each of the individual platforms. It's a little bit different for TikTok versus YouTube Shorts. The meta on Twitter versus, longer form channels is going to be completely different. So it's, there's a lot that goes in there. And I'm still learning it because my whole background is pure paid traffic. I have zero social background, which, I regret a bit now, but I think it becomes increasingly important to learn, not as a replacement for paid traffic. And we've talked a little bit about potential hybrids of the two, but I think every business is going to have to either learn it or face increasingly adverse conditions.
I agree. I think that's it. Is like, it's not that the existing model goes away, but it becomes increasingly less scalable.
Yeah.
And that kind of gets problematic. And I think that if you look at the actual numbers on like the so-called newsletter boom, that includes like Morning Brew and Substack and Medium and stuff. Because I have looked at them, and you look at them and you're like, okay, well, Morning Brew is a $50 to $75 million company. It didn't get and its huge valuation because of how it positioned the business. The valuation is really outsized compared to what a similar publisher would be at that revenue.
Yep.
But it's still a $75 million company, and it's not like it built like a new Agora, right? It wasn't an alternate Agora. Substack has, I think, somewhere like 150 million users. Medium has 300 million. The top 10 companies or top 10 newsletters on Substack, their total revenue combined was 25 million. And then Substack has taken a piece of that. So, and that's like a million some odd paid subscribers. So it's like one of the most under monetized newsletter audiences out there, for one. Because if you had 1 million paid subscribers, you'd be doing a lot more than 25 million. But
yeah.
But like the size of that is not anywhere close to the size of the growth on each of these more video centric platforms. And you can hate it, you can not want to talk about it, you cannot, but like the reality is the internet's moving in that direction. And then you combine that with a trend that has been persistent since the internet invented, which is the movement towards increasingly high quality free content by increasingly credible and sophisticated experts. And you're seeing there's going to be more and more traders, more and more influencers, more and more investing influencers who are giving out the type of content that I think the publishers give out now for a paid environment. And that doesn't mean you can't sell it. It just changes like kind of the nature of the environment, and the chances of you getting called out and punked on social is way higher.
Yeah.
Right. Like we just saw this with Real Vision just got punked by Mark Cahotis, which is kind of ironic because the single greatest piece of content they ever produced, in my mind, was that Grant Williams interview with Mark Cahotis, who was a short seller. But there's a whole thing on Twitter where they're kind of like, once Real Vision went full crypto, and with all these crypto like sponsors and everything else and things that they recommended going to crap, kind of getting punked out a bit. And it doesn't look good. It doesn't help you, right? So social is a different animal just from that perspective too. And that's scary.
With paid channels, you control the progression of that eyeball so much, and you kind of almost trick yourself into not thinking like, hey, like these people exist on the rest of the internet as well. But with social, you can't ignore it because you're getting the comments, you're getting the live feedback, you're getting all of that stuff is in your face. Because stuff does go viral, other people will see it who will call you out. So it's a different environment. And but here's the thing, and here's why I think our businesses in our space shouldn't be terrified of this, but looking at it as a pretty significant opportunity, because our whole thing for a very long time now is that we are an ideas business. We come up with ideas, and the strength of those ideas determines the performance of our editorial, performance of our marketing, and the performance of our copy. Agora literally means market, like the name is, it's a marketplace for ideas. So if we are in fact good at coming up with ideas, I truly believe it is easier than ever for good ideas to circulate today than ever before in history. You just have to understand how to do it. And I think that a couple of things become more important. Obviously, the strength of the idea itself needs to be there. Weaker ideas, or ideas that are purely a marketing invention, are probably going to be a little weaker and certainly more vulnerable to the kind of relationship stuff that we just talked about, or reputation stuff. Sorry. Authority is going to matter more, and the kinds of people that people are following for this sort of information are going to become larger and larger in stature, more mainstream. 10, 15 years ago, I couldn't get, Peter Thiel's perspective on the banking crisis. Now I can. That kind of changes things, I think.
Right.
And then, the last piece of it is just understanding the channels themselves and the meta of what makes ideas move through them. And I think that there is space for a paid traffic hybrid there to some degree, because all of those networks, virtually all, have their own ad platforms, and they virtually all prefer ads that keep the eyeball within the network. So if you want to propagate something through their network with a goal of, cooking, a bunch of eyeballs, you can do it fairly cheap that way. With the goal of building an organic audience that you then use for retargeting, or that you use in different ways down the line. I think that there's ways that this can be done that leverage the stuff that we're good at, that the social purist newsletters are not going to be good at, just because it's not their wheelhouse. So I think there's a lot of opportunity here for companies to just go after it and really sink their teeth into it, and take your best marketer and be like, okay, here's resources, here's a copywriter, go fucking tackle this. But I think it needs to be done. I think it needs to be a conscious decision on the part of pubs to go do it.
No, I agree. And I think that the way that we look at editors and like value creation within the content, because I think you're right, the ideas are everything. But now I have to feel like your ideas, so like it's not enough to say, like, if you just call yourself an insider, that's a meaningless term at this point.
Cool.
Right?
Yeah.
Especially in a social environment, if you're only ever seeing pictures in my basement, right? You at least are in the Bahamas.
That helps.
But like it's like, just look at me, right? Like as a crappy example. But when I'm showing you video and pictures of being at the NYSE, that says something different than me just saying, hey, I've been there. And then when I can bring other people from the ecosystem there and say, hey, I got everyone in, like, that says something different. And so part of moving to social is that, like, your editorial person, one, becomes more important, even more so than they are now, because like you have to build it around their personality and name. And two, like, they have to be like in the game a bit. They have to actually be like, it's not enough to just be like I mean, I'm sure there's some people who can pull it off, be like sitting off in the distance and just putting thoughts out there, versus like showing that they're on the ground in places that matter, that they're doing the work, like bringing people along on this journey through their social, because it's not lifestyle now. Now you're talking about like, no, I'm trying to use.
But there's a time where you could do guru building activities, where it's like, oh, you once swept the floor at the Chicago Board Options Exchange. You're basically a master options trader,
right? And that goes away.
That's totally gone now.
Yeah, but now it's like
as it should be, I think, because that, like, it's not great marketing, but it means that guys with real credibility, or who are willing to put in the work to actually build their networks, build their reputations, they become more valuable as franchises.
I agree, and I think that the other beautiful part about this is that, like, we know that one of the most persistent direct response copy mechanisms of all time is celebrity. Yeah. You take it from like that great Shark Tank promo that Money Map put out for Angels when it launched, like
that Shark Tank hated.
Yes. Well, they should have locked up their talent better. But like, I mean, and with this social environment, like you can use the media, like, to go out and create personality, create celebrity. And you putting money behind stuff helps create celebrity, because now you can boost posts, you can do things. It's kind of like, it's almost like, this is a random example, but Garth, you know the story of Garth Brooks changing the way that media work, or that songs ranked on the top 10. It was actually Walmart that changed it. Walmart put in an inventory tracking system, right, to help their vendors. And this is this whole other story. But prior to that, the way that you got a top 10 hit was playtime, but you could buy playtime. So all of the big record companies would just buy playtime for their artists, and that would make them top 10 artists, and now they're stars. The Walmart system was based on sales. And here all of a sudden was this artist who was not getting airtime, but he was outselling everybody by like a huge factor. And so it was like, wait, the audience actually wants this music. And then they started playing it. And so it changed like the dynamic, right? And so it's kind of, we're in this earlier stage of this now where it's like, wait, you can actually pay to boost content. And if you're producing enough, you can actually kind of build a celebrity from scratch if you get it all right. And, you know, you have a good team behind them.
To our point that we were saying earlier, like there's no more virgin fields to plow in media, like in the sense that there's not a new platform. I would say if there is anything that's still a virgin field, it's this, because it's not like there are guys who are really good at building a social channel from scratch where it's totally organic. They might be paying for some influencer boosting or that kind of thing, but it's very behind the scenes. It's not through the network. The stuff that we're talking about, I would say, is still relatively untouched, certainly in our space. I imagine in some of the more early adopter spaces, like the BizOp guys are probably doing it, but I like probably shouldn't even be saying this, but I think it's a big opportunity.
I agree. I also think another big opportunity is as you do that and as you build up like the credibility of your gurus and you have, you know, real business opportunities yourself with your distribution, doing distribution deals and joint content deals with major publishing brands that are not necessarily in our space, like Inc.com or Fast Company, entrepreneurial ones, other things like that become more and more available, I think. And so like thinking about like both the PR side,
those sorts of deals, John.
Crazy. We'll talk about that later. Yes, no, we're I mean, that's where I'm thinking is like, how do we, because I think that, you know, when I had the idea for FMS in the beginning, it was pretty simple. It was a network bridge, right, between the trader education world that was very affiliate and kind of like digital marketing centric versus like the newsletter world that didn't speak. And so it's kind of, we put them together. And then over the last several years, much of the work that I've been doing and the conversations that we've been having and things that we've done together have been around this idea of taking this ecosystem and bridging it now to all of these other capital market ecosystems, whether it's public companies, whether it's wealth advisors, whether it's, you know, the fund world, whether it's, you know, there's and everybody in between. And that's where all that excess opportunity starts to pop up, because as everyone knows, my obsession lately has been about how that world not just needs our distribution, but they also need our media strategy. They need our understanding of how to engage people online. They need the social side of it. They need the marketing side of it. They need the content side of it. Not necessarily within a FinPub model, but as the front end of all of their marketing and business development. And what they have mostly is either nothing digital or this like very simplistic content marketing concept that has nothing to do with perspective. It has nothing to do with like credibility. It's just like, here's some things that are happening. It's written by a junior content creator usually.
And they don't understand at that point the difference between news and editorial that has an actual a perspective, as you say, like that comes from a point of view of authority and from convictions about the market, about the world, about whatever it might be.
Right. And so I think that the mashing together of those worlds with our world is one of the many, many bright spots out there right now. It's also like, I found like there's a lot of excitement about it and a lot of confusion about it and a lot of, wow, that sounds like I have to change what I'm doing. And that is fundamentally unattractive. And there's truth in all of that. But there's also like a lot of other things that are happening that, you know, I think are exciting. But the big piece I think is kind of to what we were just talking about is you can be like, you could be in the inside right now. Like we can get you into the inside right now. You could be an insider. Pick
Yeah.
pick your ecosystem. Like there's a way to put your guru at the center of that ecosystem in a way that nobody else has done right now because of how young media is in the capital markets world, right? And so that then allows for like a new way of thinking about this. And I always use biotech as an example. And it's like, if you wanted to have, if you're a biotech guru, like you could literally be at the heart of the entire biotech industry if you have distribution right now. And you don't have to be selling anything to the public company world. You don't have to be doing IR or anything like that. But the chance to be in your letter is a opportunity that you offer to that world that puts you, if you wanted to, if you know how to do it, you could get into every major bank, M&A firm. You can get into every accelerator. You can get into the heart of that world and literally be at the center, and then be able to demonstrate that visually through your content and get more content, because now you're actually plugged in, not looking at it from way over here.
And you don't just know that as a hypothetical, because I know that, because we've talked about this, you've actually done some exploratory biz dev along that line. And so you know that those opportunities exist out there.
Oh yeah, I've sat down in Johns Hopkins directly with companies and with researchers, and I've talked to their venture groups, and I've talked to and I was like, oh, well, this is an easy channel for me to sit there and like just turn on. And I've done that across the board on stuff. So yeah, no, it's and so it goes back though to like, what's your franchise about, and kind of the big idea. You know, I think that the value chain of how you produce content is, I guess what we're saying, has to change.
Yeah.
Or it doesn't has to change, it's going to change by the nature of the media transformation that's happening.
It is already changing.
Yeah. And so that's where I think like there's a ton of things that, you know, I've actually thought about this, and I don't know if anyone's interested in doing it, but I've actually thought about doing a smaller group meeting of just like franchise idea and promo. Like what's the actual concept of this? Because one of the things that I love about Katusa, Marin and Marin, that they do is they bring unique value in terms of the actual investments that they bring. And I know they're Canadian, and there's a different regulatory structure. So, you know, but there's ways to do this in a US environment, but like you're getting into deals with them that you can't get anywhere else, and they're good deals.
What he does is is something that, you know, for publishers who are not familiar with Marin's work, check him out. Check out his website. See what he does. It's very different from it. It has overlaps with what we do. It's similar newsletter publication model, but the way that he brings deals to the table, the way that, I mean, it is an experiential product. It isn't just a newsletter. Prior to COVID, he was spending like, I don't know, 150 days, 200 days on the road, visiting mine sites, meeting with executives. He's been to like 100 plus countries. You know, how many editors are doing that nowadays? I mean, versus the number that are, you know, issuing options alerts from a basement in Milwaukee. You know, it's like very different.
Yeah, very different. And I think those are the kind of things that become increasingly powerful in the future here. But I had another direction there that I was going to touch on, and I lost the thread of thought.
We could pick up some of the other headwinds. Like there were like the other big one that I'd like to look at is just the whole question of churn and lifetime value, because so CPA can go up, and that doesn't matter if you're still able to monetize those names over a longer time frame, if you're able to keep them in your audience. But one of the other challenges of the last few years is our primary channel for communicating with names once they do fall into your audience has been email, which has gotten more and more difficult over time. Even just over the life cycle of Wealth Press, like the churn on a name in email when we started versus towards the end, we had some tech problems, so that it wasn't entirely down to just email more broadly, but It was very different, and it meant you had to be more aggressive about monetizing fast, which means that you were more aggressive in the sales cycle early, which means that you were pounding these names a little harder early, which also is not necessarily conducive to a longer lifespan for those names. And
Mhm.
so I think that that's a perceived headwind for a lot of people. And I think what becomes necessary there is two things. One, finding ways to monetize these names that don't have anything to do with our existing business model, which we were touching on there. And I think that we're still very much figuring that out. I don't think anyone has clear answers on what that looks like, because, as you pointed out, like Caduceus, for example, what he's able to do is very different than what, some gurus and editors in the States might be able to do. And there have already been SEC cases where people have gone on the wrong side of some of these lines in just the recent period. But that's a piece of it. But I think the other piece of it is finding ways to keep names in the audience and keep them stickier for longer. And I think in my mind, there's kind of two obvious ways to do that. One is to switch from an internal editorial concept that's not single channel, but rather multi-channel, where, again, part of it is communicating via email for sure. Part of it is communicating through other, quasi-owned channels, whether that's Telegram, whether that's, if you have more of a trading audience, something like Discord or a white label solution that's similar to that could work. And then having a heavy overlap between that and social, and having strategies to move names around between those. So if a name falls off email, but they're still engaging with your content updates on Telegram, for example, like maybe you keep that as a channel that doesn't get as much marketing, but you use it as a sticky channel. So when someone drops off your more marketing heavy channels, you can push them back. Like those sorts of strategies, I think, become more important. And again, the editorial for that has to be thought through in advance, because you can't just be putting the same content out on email, via Telegram, via whatever. It needs to fit the format. And so this again goes back to, well, like the format and how we channel ideas into actual content. We need to be a lot more thoughtful about. So I think that's potentially a big piece. And you see pubs starting to do that already, but I think it's going to become more and more important. The other thing that I think has the potential to make some of these products a lot stickier is making the experience more of a, for lack of a better term, software as a service experience beyond just a traditional newsletter experience. Even just at Wealth Press, one of their biggest offers over the last year was an indicator, and not a newsletter, but an indicator, an actual trading tool. I've heard a lot of other similar stories along those lines. But then on the free side, you look at something like, and I guess it's more of a freemium model, but Matt Paulson's Market Beat. I am a huge admirer of what he's been building, and he's been at it for quite a long time, I think. So it wasn't an overnight thing, but I think he's positioned himself really, really well for this moment. Because if someone comes in and they're managing all their watch lists and their alerts and those sorts of things through his free tool, well, I mean, unless something like blazingly better comes along, they're not abandoning that. And so that becomes part of their, if not daily, then certainly weekly trading and investment activity. And so that's permanent mind share. You don't lose that, not easily. You have to really piss those guys off to get them off of there.
Right. No, I think you're right, because like that's the other big direction that I feel like I'm seeing, is that the people who are winning more and more these days have developer teams.
Yeah.
And I know Chris Rowe is at True Market Insiders has talked about, he and I are going to do a conversation because he's thinking about exactly what you're talking about, which is it is about building a destination app and site that allows you to have the content kind of push through that is providing additional market value to them, that's sticky because of the churn issue, and how it's kind of like, you want to have your own Robinhood. Obviously you're not, like they're coming at it from the other side. They're a broker who's trying to add media and more content to keep people more engaged, but it's because that basic strategy is a successful strategy for attention. And I do think that one thing that we overlook to our detriment as an industry is how in the early 2000s trading tools were much larger segment of the market than newsletters. And I don't think that's gone away. I think one of the things that's happened is that because of some of the acquisition excitement, because this is what happens is you get a lot of acquisition and then everybody decides, hey, we should do that. And so I think that TD Ameritrade acquisition of TradeStation, was it TradeStation and or Thinkorswim and Invest Tools all merged together. I forget but
Yeah, I don't remember the details.
the brokers, the trading platform started adding tools like crazy. And so they became like kind of because they were competing for attention. And I think we're about to see an attempt. I don't know that it's going to work, but it's an attempt at the same thing with media and content models with FinPub's with Robinhood's announcement of the Sherwood Media piece, where they're going to try and create a financial publishing business. And they called people from our space. There's connections with people in our industry so that they know about, and so they're going to try something like that. And they're going to try and put media on the platform. And if they try and do media like we do media, or content like we do content with like editorial and portfolios and things like that, then that is a very disruptive kind of thing. And then it will also create, if it works even marginally, then there would be another M&A boom coming from trading platforms looking to acquire media groups to plug in and try and copy them.
And would you rather be acquired with a SaaS multiple than a publication multiple?
Yes. Yes. But to your point, like the SaaS experience, like I think that is part of, like, when we talk about mainstreaming, and it's especially true in the trading world because of the nature of trading and how trading is sold versus investing.
Yeah.
Like, I think having tools, having a destination, like, that's going to become a differentiator. It's going to become one of the main things that you compete on. I think Rob Hoffman's actually done a very good job of this with his stuff. He's done a very good job there. And I think that, like you said, Market Beat's crushing it. But like having a developer team is going to become like, it's almost like, what are the alternate kind of models that we're going to see? And I think, one is social first and one is definitely developer first, tech heavy. And the other thing that I see out there that I think is a under talked about trend is how the digital marketing in the influencer world is moving into actual financial models, not financial products or information products, but actual financial products like venture funds, PE funds, realizing that since they are distribution for actual products, that if they have a VC fund, then they have an advantage because it's almost like a corporate VC, right? Like it's a distribution channel for a certain type of product. And then if they are able to attract capital to fund companies to launch into their channel, that's an advantage on both the product side and the VC side.
Big time.
And so, like, that's the other thing is, like, I think funds as business opportunity, we see guys like Bridger Pennington and other people already doing it. We see, obviously, like, the real estate world has been doing it for a very long time. We see influencers like Cody Sanchez on the business buying side having their own funds. And so that also changes, like, kind of like in this, that kind of speaks to that issue of, will our model be the one that dominates in terms of market share as the universe mainstreams, or are people going to be looking for things like that? Like, hey, here is a mining guru who is getting me into mining deals that I couldn't get into otherwise if I invest in his fund. Is it almost like that, kind of like the largest segment of self-directed investors are actually just picking mutual funds, right? They're not actually like picking stocks. They're just like, I'm self-directed, I'm going to pick this mutual fund over this mutual fund or this ETF, right? And I think that kind of like that hybrid of done for you and do it yourself is going to create, like, that with that trend, like, there's going to be a lot of opportunity there. And so navigating from our world, which has an investor universe, into kind of those spaces, I think it's really, really interesting, really fast. And then of course raises a nice mountain of regulatory issues.
Yeah, big time. Big time. But I mean, it seems like a fairly obvious direction for some of this stuff to go. And you're already seeing some of it. I mean, you brought up Chris Rowe. He's got his money management side of the business. I think that I think that sort of thing probably becomes necessary at a certain point, because we have to find ways to move up the value chain in different ways. A fund model seems better than you know, if you're a guru and you've built a reputation, you've built authority, you don't necessarily want to be in the business of selling pay for play exposure for pubcos or for companies doing raises, those sorts of things. Even if you're super transparent around it, like, yes, you can make money, but it's not great reputation wise,
Right.
especially like, even if you believe in the thing, if like Real Vision with crypto, you know, they took sponsorship from a lot of projects, and you know, I think they probably believed in many of those, as everyone did in the height of crypto. But then when the worm turns, it's like not so great reputationally.
Right. Yeah. And I don't know, it seems like there's and I tend to, and I know this, I tend to start with the negative, right? I'm like, I'm an optimistic pessimist. Like, I want to identify all the problems, because I know that once you know the problems, you can overcome every individual problem. Right. And I think that it's, you know, it's a little Pollyanna to be like, nah, everything's gonna be fine, and not look at the actual, like, no, like, look, there's structural things that are changing in the market, and that creates headwinds, but then there are also huge opportunities. And so you just got to be clear-headed about the fact that, like, okay, some things are going to change. Costs
Well, and
might
the other thing
be
too is
persistently high.
the other thing too is, you know, there wouldn't be opportunities if there weren't challenges. If all the problems were already solved, then whoever solved them would already have collected the upside. So the fact that we're sitting here, like, you know, as an industry, wringing our hands a little bit and saying, you know, how are we going to do all this stuff? It's like, well, you know, figure it out. Maybe we'll make some money.
Yeah, exactly. And that's where, like, I do see like there's so much good stuff. And I think there's also a big difference in talking about, like, the companies who are scaled, like, in like smaller operators, you know. And I think that's another thing that's very important to make this distinction, is that it's a very different world for somebody who is in the $1 to $2 million range versus it is to be market wise, right? It's a very different set of opportunities and set of risks.
Yep.
And there are actually, I feel like right now in this period, there are actually far more positive opportunities for the smaller guys than there are for the bigger groups. Not because, well, that's not quite right. There are different opportunities. It's easier for a smaller guy to make the decision to do something different than it is for a larger company to try and have to change things or do something different, because they have a very established culture, they have a very established system, they have a very proven scaled model. It's kind of like why I rock the boat. Like, there's a whole lot of things, and they have massive opportunities, I would say. But
if you've got a team of 7, you can go in tomorrow morning and say, hey, I just saw this amazing podcast with John and Conor, and we're going social first. And you could actually do that. But if you're, you know, if you're one of the larger pubs, there's a lot of machinery there. You have a marketing calendar, you have a monthly nut that is fairly high to hit. You have all of this stuff going on. You have an existing acquisition engine that you can't take your smartest people off of, because you can't allow that to die for 3 months while you go build up social.
It's going to take longer than 3 months too. It's going to be,
it'll definitely take to figure out in the first place. Yeah. So,
and you can't abandon the old model. It's like, how do you, that's the problem with bridging, is like, you can't abandon the whole model while you're creating the new one, unless you have so much money that you could just kill the business and be like, okay, we'll just start from scratch, which isn't really the smartest thing in the world to do.
No, that's not great either.
But I do think, like, even from a traffic opportunity, right? Like, so, like, look, Substack has only got 150 million people, right? but they have some really good projects on there. For a small single operator, like how much traffic does your business need, right? Like to sustain itself. I think that's a very important question that people need to ask, is like, what is the flow of customers that you need to be profitable and grow slightly at your current level? Because when you look at it from that perspective, like, well, now there's all kinds of niche channels that are available to you to go out and get traffic, and there are like people who are aggregating traffic and reselling it to you, like that for a lot of people that sustains them, and they don't have like external acquisition. But like when you talk about social, like you could build a channel, and this is risky because you don't own the platform, but you could probably build a channel in a year or so that starts to be a significant chunk of your acquisition, um, at a smaller scale, right? Like you could probably have, like, what if 20% of your customers are coming from this other channel? It's a growth thing, but then over time that could replace your customer flow, and then the paid media is on top of that. Now you have a bigger business, but you're not going to be getting to 100 millions that way necessarily.
And I mean, the other thing too is it's the social activities, if you can make it work, is over the medium to long term is margin beneficial. You know, you look at these guys, like you talk to, because I follow a lot of fin Twitter guys who have Substacks, who have Twitter followings, and I talk to them about their experience in the newsletter industry, which is totally different from ours. They don't have sales copy. They they don't buy paid media, basically. Like they might do like a few things every now and then on Twitter that they're disappointed with the results of. But their margins are 80-90% because all of the traffic comes in from organic. So for them, you know, if they've got a business that's doing 1.2 million in sales, it's a pretty nice little business for them to run with maybe like 1 or 2 employees.
Right.
So it's a different thing.
Because I do think that one of the other, like, I would say industry-wide changes that happened in COVID kind of like marked the period of time where this changed, is we had this period of time where we pre FTC stuff, and FTC definitely killed this because it was the companies that were non-Agora companies, non-MarketWise companies that like yours that were growing quickly, that got shut down, got hit, like Raging Bull. But we had this period of time where you had this, I would say, mini exodus of talent from the larger newsletter world coming into like more independent, smaller space. You had companies like yours that were growing very, very well, hitting the 50 million, Raging Bull pushing 100 million. We had more companies coming up. And so we were actually building a healthier ecosystem outside of the Agora world, that was really good for the industry and was, you know, I would say beneficial as a whole for the whole ecosystem, both from a talent perspective, an idea perspective, marketing, like all kinds of things. And then the FTC case is kind of like killed the two leading companies that were part of that. And we're seeing like the repatriation of Agora talent in that sense. Like Brett went back to Money Map. Joe went back to MarketWise, much to Porter's chagrin, as we all know. And like that creates like this other environment now where the smaller, we've always had this like kind of smaller ecosystem of companies in the $1 to $20 million range, $25 million range, who are kind of like it's like you could say compared to the bigger groups, a little like a minor league, like a farm league, but have some really fantastic small publishers in the space, and they're looking at their opportunities to either scale or not scale, and that is where, like, you know, if you can't find a beneficial acquisition channel, whether through social, whether through it's organic, whether through paid media, you're kind of like on a deteriorating asset. And then that's very different than the big guys who they can launch new pubs, they have a huge universe, they can spend the money to like and wait longer to get their money back. And their issue is, can we scale at a good price? And they're having a real hard time finding the much harder acquisition copy at scale to work. Whereas at the lower level, I think you can I think you can grow your customer base without like having huge copy problems if you actually have like worldview, if you have copy
Yeah.
that reflects that. And
On the strength of the ideas.
yeah, yeah. And so I think that's where like the smaller, it's almost like one of those things where like the smaller space right now is, I think, has the opportunity to be more vibrant, but it has to be more active in terms of testing new ideas and channels and things.
Well, it's funny, right? Because our space is so good at monetizing a name once it comes into anywhere, and moving it around and selling and getting a lot of different offers in front of it, and copy within the bounds of what we're allowed to do. These guys don't know anything about sales copy. They don't know anything about paid acquisitions. They have a certain amount of organic growth that comes from whatever social channel they came up on, which a lot of it's Twitter. But in the trading space, a lot of it is TikTok or is Twitch, that kind of thing. And we got to, as an industry, kind of figure out how we do business with each other, because these guys are probably never going to figure out all this direct marketing stuff. But at the same time, you can't really approach these guys over here with the same kind of guru deals that have prevailed for a really long time, for like 5 or 10 or 15% of gross net of refunds or whatever it might be, because they're like, well, I'm making $1 million a year over here, and maybe this makes me another million, maybe not.
Right. That's been one of the recruiting problems just in general from the digital marketing space, the BizOps space, is like, trying to hire people who are good at a certain task over in BizOps. It's like, yeah, but I make like $500,000 to $1 million a year and I work 20 hours a week, because they're really rich markets in terms of like their ability to convert. And so like, it's hard to recruit people who are good, because if you're good, it's a huge market, and it's bigger than our market, I would say. And it supports the same levels of price points. And so that's a really nice place to be if you can find a niche for yourself. And there's a lot of overlap with finance. I think that's another big mistake that we make, is that we ignore the opportunity with non-financial marketers and publishers more than we should. And I think that those things that's one of my goals this coming year here, is to try and put more of those folks in the room with us to talk about like their social, talking about like the BizOps side, the real estate side, what's working for them, what are the opportunities to work together. Because I think it's like, one good media source can sustain a small business for several years, and create, again, just a ton of ancillary and new opportunity.
Yeah, big time. It's going to be an interesting couple of months, years over the next little bit, as everyone kind of scrambles to figure this stuff out. And there's probably gonna have to be a lot more conversations like this one, and a lot of failed experiments. I'm sure I'm gonna have at least a few of those, as one does.
Same. That's the nature of it.
But to return back to like the original idea, the original kind of premise of this whole conversation, the tailwinds are real. They're there. The challenges are real, and they're there too. But if you solve those, or even if you solve one of the big ones, the value of that is immense. That's potentially, like, solving one of those in the context of these tailwinds is potentially a career defining business. So it's a period where it's going to be a lot of work. It's going to be a lot of challenge. It's going to be uncomfortable, but the opportunity is very legitimate and very, very bigger than, and we said this before too, but like, it's not about making the next Agora. It's about making the thing that kills the idea of an Agora being the pinnacle of financial media.
Right. I think that's it, is that, and I think we probably need to do a second conversation that we can record, because this is a very big conversation too. But it's this idea that media as a function of business development across the B2B world is on the rise.
Yeah.
And within financial and capital markets in particular, the opportunity that presents is so substantial when you really draw it out, that it's on par with the opportunity to and this is something that I've heard when I've talked about this with folks who are very veteran, very high level, like kind of bankers, and have worked for some big firms, like the iconic firms and stuff. When I've kind of laid it out, I've heard people like describe it back to me as like the type of change that you're seeing and you're talking about here is on par with creating a new Goldman Sachs through media, like a modern day version where like all of the functions that they do on the front end to acquire customers, to acquire deals, to acquire like investors, all of those functions can be wildly disrupted and scaled using media models. And that is what's so fundamentally like shocking, is that opportunity presents itself across the board, all across the financial market. It's happening outside of the financial market too. It's happening in everything, every corporate America. It's happening everywhere. But like that presents like a crazy set of opportunities that from a valuation perspective gets kind of nuts. And so to your point, I think that's like, you're right. Like you're talking about something that could be worth you're talking about not just $1 billion company, but things that could be up in the multiple billions and tens of billions in terms of valuation.
Absolutely.
And so,
and it's like you almost don't want to talk about those numbers and some of the blue sky of it, because I think when we do talk about that, it scares people away from almost taking the transition seriously. I think when you and I were talking about this stuff like 3 or 4 years ago, and the conversation would skew to like that end of it, people would be like, yeah, these guys. But now people are seeing it start to happen. And that'll just, so the inevitability of that, I think, will be more pronounced every year.
Yeah. And I think like the reality is that those established interests are all there to stop that from happening, or to kind of make sure that it happens within their model. And so
and that
so
they get to control the pieces.
Right. But then that just means like there's an opportunity here to do like an I love the way Ian Rosen from Tiffin describes it. He's like, we're sitting in a world where like there's just multiples sitting on the ground waiting to be picked up. That's how I look at it, is like, oh, this is the build to sell period, like, par excellence. But that type of business, fundamentally, if you're doing a build to sell model, is usually not a bootstrapped model, which means you're going to get into the capital raise conversation. And that's starting to play a completely different game, which I think is a very exciting and interesting one, but it's not necessarily talking about like selling subscription products. But it is a big one that we should probably do a second conversation around.
Love to do it.
But in terms of like the future of FinPub, then, like, I know my perspective isn't that like all this stuff changes overnight and you're if you don't make these changes in 3 years, you're gone. No. I definitely don't believe that. I think it's going to be one of those things where we see a slow shift that gets faster. It's like it happens slowly and then all at once. And you just see, I think what we'll start to see is more and more of the success stories that we start to see are going to be in these kind of other areas more and more. And that's going to kind of drag everybody along.
I totally agree. Like, I mean, the takeaway from this shouldn't be you have to go and reinvent your copy and master every social channel and, build a SaaS business and start a fund. You should, pick one activity that you can do that takes your business in some of these directions. And it could be picking a social channel that you think that your content might be suited for, and starting to put together a strategy for that, and then just creating that first piece of content, which will definitely be terrible. But then you create the second and the third. Like, I saw a great, I don't know if Mr. Beast put it, I don't think he put it out on his own channel, but he was talking, I think it was a podcast with someone else. And he was like, don't even look at your view count for the first 100 videos. It's not until you've done that first 100 videos that you'll start to see out of that which of your pieces worked and which didn't. And so that's I think with a lot of these social channels, how you kind of have to look at it. Now, if you have a media budget, you have the advantage of when one of your pieces gets positive signal, you can boost it with money as opposed to just relying on the algorithm. But yeah, I mean, that's what it's about. It's about like taking one step, putting out a first piece of content, mapping out, you could map out what a theoretical MVP of software experience of your existing information products might be. And it could be something super simple. I mean, yeah, it's just take one step, pick one thing, start executing.
Yeah, absolutely. So, all right, man. Well, this has been a fantastic conversation. I always love talking to you. So thanks for doing it.
Yeah, likewise. Thank you for having, I've been wanting to do one of these for a bit. So this is fun.
Yeah, we will definitely do a second one because I feel like we're like not even halfway into the conversations that we normally have. So
right.
All right.
Awesome. All right, John. Catch you later.
Bye.